Hello and welcome everyone to the third Beyond GDP Spring 2023 meeting. Today's topic is what is the role of environmental, social and governance data within Beyond GDP. Stefan Sweinsfest, the director of the UNSD, usually attends such meetings. However, he's unable to do so today as he's on mission, and he wishes everyone all the best, and he hopes that the participants can share their insights as actively as they have done in the past two meetings. And also, on behalf of everyone at UNSD, we would also like to thank all the excellent presenters for taking the time to attend today's meeting to speak on their respective topics. And also, before I hand over to Cleona, who will give a quick recap of last week's meeting, we hope that everyone can look at all the messages on the administrative arrangements for the meeting that we'll be adding. So please look at the chat, and also without further delay, I'll let Cleona take over and give a recap of last week's meeting. Thank you.
Brilliant. Thank you so much, Benson, and thank you everybody who's joining today. And we'll just get the IT set up. Okie dokie. Benson, would you mind confirming that you can see those slides?
Yes, they are. I think they are in slideshow already.
Yes, perfect. Great. So we have another fantastic agenda today. Just to quickly touch on that, we're focusing on environmental, social and governance today. So we have quite a few brilliant presentations coming up on that, including the International Sustainability Standards Board, aligning wellbeing concepts and metrics with ESG, including sustainability information in financial reporting, and then talking about sustainability reporting. So very interesting to see what sort of common themes will come out today. But to take a quick zoom out from this particular sprint, and I was thinking a little bit earlier about what the correct metaphor would be here, and I think a little bit about when I watch the London Marathon and I see the zoom in of the runners at the front of the race, at the middle of the race. I see all the great things going on, and then I see the zoom out and I see exactly where all these fantastic locations are located within the city as a whole. And I feel that's what we have here. So just to locate ourselves within this marathon that is comprises all the individual sprints, so that the pacing of things, we have these different sessions going along. We're moving from the second to the third at the moment. We started to touch last week on the wellbeing themes and the research that has been going on into what users want out of wellbeing. And today we're really starting to dig down into some of the specifics of that and talk about what the role of ESG data within Beyond GDP is. So this really gets across just how much we're trying to do at pace at the moment. There's an awful lot going on. There's a lot of sprints that will make up this marathon. But if we've zoomed out from one position, the view of the whole, if we now go back to what where we were sprinting last week, one thing just to bear in mind is that the thing that connects all of these together is the research prospectus that the network put together recently, which really provides a framework for how we're thinking about the work of the network and how it feeds in and how it draws together different areas. And this diagram on the right hand side gets that across. So there's certain frameworks that are already available that are heavily used, those being the system of national accounts and the system of economic environmental accounts. But in the process last year of talking with users about Beyond GDP, we got to this point of the need to draw together also those social statistics that are really vital for the purposes of Beyond GDP, and then some sort of central framework that really helps understand how these different frameworks are drawn together. And last week really put a little bit of flesh on the bones of what we mean by that. We had several brilliant presentations that covered lots of different areas, but actually there were some common themes that really stood out to me. So one of those was We have a lot of work that has gone into the technical side of things, the statistical side of things. Quite a few areas of research now are into the governance, how, and talking about narratives, how we take the data that we've already produced and we make it useful for policymakers, make it accessible, and really start to draw out some of those benefits. And that drew from an increasing understanding of exactly what it was that has given GDP its institutional role. There were bits of research that really drew out what it was that has embedded GDP within particular processes and how we might go about extending and inserting the beyond GDP measures that we have at the moment into those. So that really gets at the sorts of work that this framework will be aiming to try and help. So those were some of the things that we covered previously. And with that, I will hand over to the next presenter and we'll start sprinting again.
Perfect, thank you. I'd like to start by welcoming all of you to this third sprint session. I'm Sonia Rezen from Statistique Canada. I've just joined this community, so it's completely normal if you don't recognize me. As Benson said initially, the topic of today's session will be the role of environment, social, and governance within the Beyond GDP discussion. So this is kind of an exploration session. We value your input, so please don't be shy and participate actively in the discussion and question period, please. Before we start, I thought I would just highlight a couple of basics around ESG, just in case some of you are not familiar with the concept. So ESG measures non-financial performance by measuring environmental, social, and governance risk for an enterprise. Enterprise do have an impact on individual and society well-being, but the opposite is also true. So well-being of individual do have an impact on enterprise performance. But up until now, and I'm talking about my own experience, but the majority of research and analysis has been treated ESG and well-being frameworks in isolation. So with today's speakers, we will provide a different perspective in an attempt to build a bridge between the two framework, ESG and well-being data. So without further ado, I'll turn the mic to our first speaker, Richard Barker. Richard is a board member of the International Sustainability Standard Board, the ISSB, commonly known as the ISSB. So the ISSB was created following the COP26 in 2021, and the mandate of the organization is to develop standards for sustainability reporting. Over to you, Richard.
Thank you very much for that. That's a very nice introduction and a way of setting up what I hope to talk about. So I think what would be, I'm going to share one slide in a moment, but just to give some overview here, I think that the very broad context for this is what brings us together from quite different sort of institutional settings. And there's a lot of this going on right now. So the shared interest in sustainability, ESG, associated with well-being in various ways, comes from this being a huge set of complex collective action challenges. And so there are multiple individual institutions all flowering up all over the place, and also multiple touch points between existing institutions in ways that are difficult to get your mind around. So, and this I think is a really good example of that. So if you take the world of financial accounting, which is very closely related to the world of corporate sustainability reporting, and you compare the world of corporate financial accounting with national income accounting, so that's closer to the setting for most people here, sort of measuring GDP. Those two worlds are almost entirely independent of each other. You know, they shouldn't be, right? So how you measure corporate performance ought to be much more closely related to how you measure national performance, as it were, but they're separate, they're institutionally separate worlds. They've never really needed to come together very much. Whereas in this space, it's unavoidable that they're coming together. So it is quite subtle and quite complex, the various interactions. Let me just share a slide, and then you can get some sense of where we fit into that landscape. I'll try to do this relatively quickly, so that I can answer any questions. I think that's probably the most useful thing I can do. Now then, Okay, there we go. I've got so many windows open. Can you see that? Yep.
Yes, we can. Thanks.
Okay, great. Okay, so this is 3 nested boxes that illustrate different lenses on corporate reporting. So, and to emphasize corporate reporting as a subset of some broader macro level of reporting. So if you take the blue box, the smallest box, the dark blue box, this is financial statements, corporate reporting as traditionally done. Now, there are basically 2 standard setting bodies globally that are significant in the context of setting standards for corporate financial reporting, which is the IFRS, or the International Accounting Standards Board, which is the sister board of my board, the International Sustainability Standards Board. We're both part of IFRS, and IFRS sets accounting standards in a way that's mandatory in about 140 countries around the world, and that for an additional 20 countries or so, IFRS standards can be used. The additional 20 includes the US. So the United States, the Financial Accounting Standards Board, is the one significant exception to large domestic companies using international standards. But nevertheless, within the US GAAP is very similar actually to the rules, as it were, of IFRS used globally. So for financial accounting, we have a very high degree of harmonization around the world. Now then, the light blue box here is reporting more broadly than just on financial performance, but reporting to investors. So we wouldn't describe this as non-financial reporting. We describe this as a broadening of financial reporting, because you are reporting to your providers of finance. So the issue here is that increasingly investors have been demanding information that isn't just how much profit did you make last year, but that's broader. And the broader is ESG reporting, emphasis on the E and the S, I would say. So on the environmental side, the reporting would be you're an organization with a high carbon footprint. You're going to have to transition to have a low carbon footprint if we take Paris targets seriously. That's going to have big implications for your business model in all kinds of ways, whether it affects your business through your reputation, through your ability to recruit, through the size of your markets, through the development of low carbon competition, and whatever it happens to be, it's going to affect your business. So a sustainability related financial disclosure would be, tell us what you're doing about this. Tell us what your net zero target is, what your transition plan is, what your emissions are in the first place, and where they exist in your value chain, and so on. So that's carbon, but you can imagine very similar disclosures around other environmental issues. You're a business that depends heavily on water, and you use water in water stressed areas. How are you going to respond to that? What are you going to do? How are you going to carry on making money? You're a business that operates, you're exposed to the domestic markets in California and Florida, and 2 of the largest insurance companies in the United States have just stopped offering property insurance in those 2 markets for climate related reasons. How does that affect your business? What are you doing? How are you thinking about it? Should you be making similar decisions? So those are environmental sustainability related financial disclosures. On human capital, social capital, sort of closer to, more directly close to a well-being theme, although I think actually the environmental stuff is incredibly close as well. If you think about risk of mass migration and all that kind of stuff associated with environmental. On the human capital and social capital side, you might be asking questions like, what's your performance on equity, diversity and inclusion, because it's starting to affect investor perceptions of your business, willingness of employees and consumers and so on to engage with your business. You may want to know, well, what's your exposure to human rights abuse in your supply chain? and we've seen numerous examples of that and the sort of the impact that can have on corporate reputation and so on. And then also less obviously, but also relevant in this space is corporate is more positive sorts of metrics. You know, if you are creating a working environment in which people thrive, is that something which is good for your financial performance, and can you demonstrate that to us? So more directly, well-being type metrics will fall into that space as well. Well, I think it's worth emphasising that the motivation for reporting in this space is not tell us good news stories. It's tell us what exposure and risk we have to bad news stories, right? Climate change is not a good news story. Well-being is a way of framing human and social capital type metrics as a good news story, as opposed to human rights issues, which are a control of a bad news story. So broadly in that light blue box, the issue is report to your investors any risks and opportunities that you have from this in this space. An opportunity, a good example of an opportunity would be if you look at the growth in the market of non-dairy milk, for example. The dairy industry is a hugely environmentally damaging industry. The non-dairy industry is growing like crazy, right? And a few years ago it didn't exist. Now it's massive, and it will continue to grow. And so you have very obviously a market opportunity in response to a societal risk. And so you see the same pattern across all E issues and all S issues. This is about risks and opportunities. Finally, and by the way, and that box, that light blue box, that's the space occupied by the ISSB. So our role is to set standards that complement financial accounting, providing investors with relevant information. And that's also the same space as the SEC, because they have an explicitly investor-focused mandate, and so they proposed, when it comes out, the SEC climate disclosure rule is aimed at providing investors, for the purpose of investment decisions, information relating to climate. TCFD is in that space, TNFD is in that space, partially. So meanwhile, the grey box, the outer box, finally, is corporate reporting to stakeholders other than investors about impact on them. So in a well-being context, it might be that actually employee well-being has very little relationship with financial performance, either currently or prospectively. And actually, it's the business model works just fine if employees are miserable, right? But if you're the employee, it's not working just fine. So the grey box is reporting to the employees. What's corporate performance from your point of view? Or if you think about biodiversity, for example, which is much lower on the radar than climate from a corporate point of view, the grey box is likely to include more, relatively speaking, more reporting on impact on nature, impact on the environment. And over time, you would hope that, from a societal point of view, you would hope that information that's currently in the grey box moves into the light blue box. In other words, investors, as it were, start to care about externalities imposed on society. So think about the grey box as being largely an externalities box, but a box that's increasingly important over time. I think that's probably enough to say to prompt questions. So let me, Sonia, let me pause there.
Perfect. Thank you, Richard. This is a great presentation. So if I'm not mistaken, you have other engagement and you'll have to leave in a couple of minutes. So please, I'd like to ask.
Yes. So yeah, questions very welcome.
Okay, so we're going to have a short question period right now. If ever you do have questions, please raise your hand in the Teams and I'll make sure to give you the mic. Don't be shy, I'm sure someone has a question.
Well, nothing to say while people are thinking, and if there aren't any questions, that's fine. But we as an organisation currently have, in fact, two more things to say. One is that we currently have as of Monday, actually, is when we formally issue our first standards, a general disclosure standard that covers all sustainability issues, and a specific standard focused on climate. We also have an agenda consultation, which is seeking stakeholder opinion on what we should do next. So, very crudely, environmental or social would be one way of characterising what do we do next. The other thing to say is that meanwhile, within Europe, and critically, this is not just a European issue, there will be shortly mandatory standards covering a whole range of both environmental and social metrics for both investors and impact on other stakeholders. So this is potentially a huge mandatory disclosure environment coming in really quite starting for next year. In other words, they need to be collecting these data now, pretty much. This is a huge, not least for European companies, but also for any pretty much any company of any size with substantial operations in Europe will also be captured by the same legislation. So in the United States just now, there's a great deal of back and forth on the climate disclosure rules. Some are strong support, some are strong opposition. But the climate disclosure rule in the US is decidedly modest on small scale in relation to the range of legislation that's coming in very quickly in Europe, and that will capture overseas operations.
اسمع هذه حق الجي دي بي عادي. اسمع هذه حق الجي دي بي.
Is there a question?
I think that's a non-mute.
Okay. So Richard, have you heard of anything coming as legislation in Canada or in the States or in the Americas?
Canada, I would expect, will adopt the our standards, the international sustainability standards, border standards. I'm actually calling from Montreal right now, which is where the ISSB is jointly headquartered. So there's very strong Canadian support for a global solution, and the global is hugely important here. Sustainability related information is not just information about the entity doing the reporting, it's information about the value chain of that entity. So any entity of any size doing sustainability reporting is reporting globally. If you think about where its supply chain extends to, where downstream it extends to. So if you don't have globally comparable, consistent data, then sustainability reporting is a nightmare to do. So Canada gets that, and so Canada is already sort of sending very positive signals about not just using IFRS but also hosting the ISSB in the first place.
Yeah, I know Canada's support, but I'd like to see a legislation to enforce it.
Well, yeah, I mean that's what's no country has legislative adoption in place yet for sustainability, for our sustainability standards, although they do for the accounting standards. And of course, Mark Carney's been a major driving force behind all of this. There's a strong Canadian voice at the heart of much of these endeavours.
Perfect. So last requests are, do you have any question in the room? I saw one hand up and then down.
Sonia, there's a comment in the chat. Maybe
okay.
I don't know whether you or Richard want to address that. Thanks. It's a question actually. Thanks.
Okay, so the question is, there is a lot of talk about greenwashing. How do you see that issue?
So in principle, the transition from sustainability reporting or ESG reporting, however you want to describe it, going from voluntary to mandatory is an absolutely critical step, and including assurance is an absolutely critical step in addressing greenwashing. It's not some sort of final solution because there's a lot of this is new ground. There's a lot of subjectivity in reporting. But I think what we are seeing is much more scrutiny of high-level claims. So if a company says, right, we're going to be net zero by name a date, the question now is, well, okay, show us how you're going to do that. Show us your transition plan. Explain to us how you're going to get there. Explain what capital expenditure is required to get there. Explain what you can abate easily and what's going to be more difficult to do, and so on. So there's much greater scrutiny on the credibility of claims, and that comes naturally with disclosures being both mandatory and assured and more generally understood to be important.
Thank you. And one last question on my behalf.
And by important, by that, I mean economically important. So again, to take the insurance example I gave you, if you're an investor in US insurance companies right now, the news about stopping household insurance is enormous, right? As in terms of the economic consequences for the sector.
So just one more question, and then we'll have to let you go.
Sure.
So on Monday, the ISSB will release, I think it's the 2 first initial standards. But when do you expect the next one? Is it going to take approximately 18 months to have a new suite?
Something like that. But to be honest, the first one covers everything anyway. It just covers it at a very high level. So it's filling in the third and the fourth will be filling in the details. As well. What really matters actually is, as I see it, is that the climate standard is embedded well, because if you can do the climate, because not only is the climate the sort of the dominant societal economic concern, but if you can do climate reporting well, then you've got the governance, strategy, risk management, target and metric process in place. You've got the translation of environmental impact into financial performance in place, the narrative for your investors, and you've got the systems in place to collect data from the whole of your value chain, from all the way upstream and all the way downstream. So if you can do climate reporting well, then actually doing the rest of it well is, relatively speaking, straightforward. But it's not easy to get that system, that sort of mindset and system change in place. So it's a journey that starts with climate, is the way I would describe it.
Perfect. Thank you for your input, and I'm glad you were able to participate in today's discussion.
Likewise, and thank you, and I hope you have good discussions.
Thanks.
Okay, thank you. Bye-bye.
Bye. So we're going to move now to our second speaker, which is Vincent Sickering. He's an economist at the OECD in the Wellbeing, Inclusion, Sustainability, and Equal Opportunity Center. His presentation will focus on aligning well-being concepts and metrics with ESG. So, Vincent, over to you.
Thanks so much, Sonia. I'll just put up my slides. I think they are coming.
Yes, we're seeing them.
Yeah,
thanks.
It's a real pleasure to be here. This is a topic that is really animating us at the moment. I think we really see ESG as a critical vehicle for making the broader Beyond GDP agenda successful, and to really embed well-being in policy making and in the way we do business. So I think this is a really critical topic, and I'm really happy to share some of our thoughts on how we see the link between ESG and well-being with you all today. Maybe just to start with a brief reminder of the OECD's response to the Beyond GDP agenda. At the OECD, we have developed a conceptual framework for well-being, which is the OECD Wellbeing Framework. We have developed a lot of indicators and measurement guidelines in collaboration with national statistical offices on how well-being can be measured and various aspects of well-being, improving the evidence base, and we regularly report on countries' well-being using our House Life report. And we're increasingly also working on how well-being metrics can be used in policy-making processes. And most of my colleagues work on the topic of well-being with national governments and national statistical offices. And it's my role in the OECD Center to translate that work to the private sector, to businesses and investors, and to see how we can make those linkages. The OECD Wellbeing Framework, I'm sure many of you are familiar with. It is really at its heart a multidimensional framework of outcomes. That is the best way to describe the OECD Wellbeing Framework. It is multidimensional in nature. It covers both material conditions such as income and wealth and work and job quality, but also what we could call quality of life dimensions. So work-life balance, social connections, safety, really giving that multidimensional view of how people's life is faring in the spirit of the Beyond GDP agenda. Well-being can be measured with both objective and subjective aspects. And as I said, the focus is really on outcomes rather than inputs and outputs. And aside from the 11 dimensions of current well-being, which you see on top of the framework also considers 4 resources or capitals for future well-being. So natural, human, economic, and social capital. We have also found that when you compare national well-being frameworks that countries have produced over the past decade or so, that they really share a lot of characteristics with the OECD well-being framework. So there really seems to be a common conceptual core across a lot of countries, at least, of the common aspects that matter to people. And this suggests to us that the OECD well-being framework is quite effective at capturing these various components of well-being. So what about the private sector? Why should businesses or investors care about well-being and the well-being of their stakeholders, perhaps more specifically? Sonia, you already alluded to some of these reasons, and so did Richard. Some companies care about managing the well-being of their stakeholders for intrinsic reasons, but there are indeed also financial reasons for why businesses might care about well-being. Businesses are dependent on their stakeholders, perhaps especially employees. And I'm not sure if Jan is joining us later today, but he and his colleagues have done a lot of great research on making the link between employee well-being and productivity and various aspects of business performance. And so there's quite a bit of evidence around that. And as Richard said, also poor treatment of stakeholders can give rise to risks to businesses. What I think is emerging more and more in recent years is also the idea that businesses and especially investors have an interest in managing business impacts on society and the environment, also from the perspective of managing systemic risks and opportunities. So the idea that, yes, there is a link between the well-being of your employees and direct financial performance, but beyond that, also, the well-being of people in general can present systemic risks for our societies more fundamentally, and this could threaten long-term economic and financial performance for the markets. And so that provides an additional incentive for business and finance to care about well-being, and really for investors to access information about the well-being of stakeholders and how businesses are the efforts that business make to improve well-being. And so that's very much along the lines of what Richard was just saying. A few years ago, we did a stock take of existing frameworks that assess the way that they treat business social impacts. It's a few years ago already, but I think the observations still hold to some extent. And these were frameworks in use by big businesses and also standard setters. And what we find is that in the social dimension, there isn't really an agreed conceptual framework to assess business impacts on people. Richard also mentioned human rights. There's well-being, inequalities, diversity, and inclusion. There isn't this coherent conceptual framework on how these concepts relate. And these frameworks we observed don't really reflect the various aspects that matter to people, at least from a well-being lens. And especially the outcomes that matter to people. And those frameworks tended to focus on measures of activities or outputs that may be relevant, but in order to really understand firm performance, and that's something that investors are interested in as well, we really need to measure the outcomes. We also looked at the various topics that these frameworks consider, both in terms of the provision of qualitative data as well as the qualitative information as well as quantitative data. And we really noticed that for many of these well-being dimensions, businesses and related standard setters don't really have quantitative measures that are in use. And so it appeared to us that there's a strong opportunity to leverage the existing measuring well-being in the national statistics community and apply those metrics to the private sector. So in response to that, we wrote a working paper that provides a conceptual framework for how the social dimension can be thought of. It looks a bit complicated, and sometimes I regret the way that we presented it because the message is really quite simple. And that is that, for each of those stakeholders, be it employees, consumers, workers in the value chain and communities, firms can and should try to measure the various facets that are important for these stakeholders, the various dimensions of well-being, and that a lot of existing metrics already exist to do so. In addition to that, we know that firms contribute to societal resources as well, and you see that in the top of this box, things like the taxes they pay, research and development, things like that. But for these stakeholder groups, it's really important to develop good metrics of outcomes and to align those metrics with those that are in use by national statistical offices. We also made the observation that for the group of employees specifically, it is particularly feasible for businesses to better measure outcomes, given that that is a stakeholder group that's particularly close to the firm, and also that there's some universal aspects of the working environment and well-being that apply to all employees. And so that is low-hanging fruit for greater harmonization and the measurement of outcomes. And so to summarize, the benefits of leveraging well-being measurement tools in an ESG setting is really to fill the gaps on metrics in the social dimension, go beyond output indicators to measure stakeholder well-being outcomes, and to really try to align firm level and societal level well-being metrics, which could allow which could provide greater data interoperability and could allow us all to compare micro level outcomes, so at the firm level with macro or sectoral level outcomes, which could really provide a rich source of new data also for statistics providers. I'll say a few more things about measuring employee well-being, given that that's something that we observed as perhaps low-hanging fruit for greater harmonization and measurement. Based on this observation, and given that the OECD has written these guidelines on measuring subjective well-being and the quality of the working environment, among others, which are being used by national statistical offices to measure these various facets, we decided to try and do a pilot where we produced an employee well-being survey that firms could use to measure working conditions and well-being outcomes in their employee populations rooted in these guidelines. And so the benefit of this type of survey would be for these firms that they get to compare their performance with other firms, and also if their country uses these guidelines, that we could that they could compare well-being outcomes between their employees and well-being outcomes at the national level, and so that data becomes much more rich. And so this initial pilot we did in Japan, and we are looking to expand this pilot with businesses in other countries as well. And the businesses that participated in this were presented with a well-being report that really shows the multidimensional well-being of their employees. which we hope will allow us to better manage the well-being of their employees, and you know, potentially, if they are committed to transparency, to convey this information to investors who might, you know, as we observed before, be interested in, you know, business performance on stakeholder well-being. I'll end by highlighting one more future initiative, which is the fact that we are currently in conversations with a group of civil society organizations, business organizations, and other international organizations to discuss the potential creation of a task force on social and/or inequality-related financial disclosures. And so this is really in the same sphere as Richard was referring to before. In fact, the ISSB's climate standards is going to be very deeply rooted in the work of a previous task force called the Task Force on Climate-Related Financial Disclosures. And that task force developed robust disclosures for climate-related risks and impacts for firms. And the idea would be to explore whether a similar task force could be created for social and inequality-related financial disclosures, given the gaps in metrics and given the absence of a comprehensive conceptual framework in the social area. So we are currently exploring this possibility with this group of stakeholders. Once this really gets going, I think it would be really critical that we get the statistics community on board as well to input in this work, which really is intended to be a multi-stakeholder effort to create, you know, a strong conceptual framework for these types of disclosures. So I'll leave it at that, and happy to answer any questions.
Thank you, Vincent. This is a great building block for today's discussion. I'd like to open the mic, and if you do have a question, please raise your hand and I'll make sure to give you the mic. This was news to me, Vincent, the pilot project you're doing on kind of crowdsourcing the information from employees. This is exceptional.
A project that we started last year, really with the observation that many businesses or some businesses are starting to measure the well-being of their employees or some aspects. There are some private sector entities that are providing a little bit of standardization, but I think a bit of coordination in that space would be welcome, and especially alignment with, you know, the types of metrics that are being collected by statistics providers, because that macro link would make the data much more useful.
And hopefully Jean Emmanuel can join us a bit later on. But did you have a discussion with him to be able to build this this pilot?
So we are still going to discuss this type of collaboration. For now, we circulated this with the OECD's Statistics Committee, and I think Statistics Canada also reviewed this, and yeah, we are collaborating with the statistics community on it.
So I saw one end up. Philip Settle.
Thank you. Good morning or good afternoon to everyone. My name is Philip Settle. I work at Vital Strategies on the Bloomberg Philanthropies Data for Health initiative, primarily in civil registration and vital statistics in low and middle income countries. I'm very honored to be part of these sprints, so thank you. And it's been very interesting. However, it's way outside my area of domain knowledge, and I have a kind of application question. These metrics of well-being, I'm not familiar with the data sources or whether there could be routine and administrative sources leveraged to inform us about both individual level and group level metrics of well-being in low and middle income countries where we're still struggling to count everyone, let alone figure out how well they're doing. So if anyone has some thoughts and reflections on the sort of feasibility or potential sources of data, particularly routine and administrative sources that might be looked to in low and middle income country settings. Thanks for the opportunity. Over.
I'm happy to give a quick stab at that question, although I'm not sure I can really do justice to your question, Philip, but there is a big capacity issue with measuring well-being even in OECD countries, and we know that our national statistical offices in OECD countries sometimes struggle with this as well. The types of well-being metrics that I referred to in my presentation today primarily refer to self-reported aspects of well-being, so the types of metrics that are gathered from surveys. And OECD countries implement large population surveys on various aspects of life or working conditions, and that's how they derive some of this information. It's true that some aspects of well-being are objective, and there are really a range of different sources depending on the well-being dimension. All I can say is that it is very challenging for any country to measure well-being in a comprehensive way, let alone low and middle income countries. I don't know that there is a very easy answer to that.
Thank you, Vincent. We have one other hand up, and then we'll have to move on to the next speaker. So Aldo, you have a question.
Hi, everybody.
Hi.
This is Aldo Femia from the Italian Statistical Office, National Statistical Office. There's a microphone on, if could be. Okay. Now, well, there was talking about business impact on people, and there was a question before about greenwashing, and sometimes the two things may be connected. I was thinking about the scandal that the certifying body for emission permits, Verra, underwent some time ago. There were allegations that up to 90% of the bonds issued based on carbon compensations were junk, with no real compensation behind them. And on the other hand, I know there are several organizations of forest people who complain because they're feeling expropriated by programs of fortress conservation, such as the ones we have in so-called nature-based solutions like REDD+, etc. Now, this is definitely something connected to business impact on people and greenwashing at the same time. And I wonder what kind of attention, what level of attention is given in this context to those organizations who are particularly attentive on these aspects. Thank you.
Yeah, I can give a stab at this question, although I think there is no silver bullet. Disclosure standards are not a silver bullet, and this type of survey is not a silver bullet in terms of getting transparency on business impacts, right? We are always going to need to rely on a complex system with multiple checks and balances, right? But I do think that investing in these measurement capacities by businesses, harmonizing metrics where possible, you know, is going to be an improvement and is going to shed us more light on certain aspects of business impact, knowing that ecosystem on transparency and accountability is always going to be necessary.
Thank you, Vincent. We're gonna go with our third speaker, Ellen Slinger. So Ellen is an executive director at the Accounting for Sustainability. And I'm not sure if I will present your topic properly, Ellen, so please don't be afraid to realign me, but I think you're going to present on your community's data needs. So accounting community and also other stakeholders' data needs in terms of ESG. Over to you. Thanks. Oh, you're on mute, Ellen.
Great, thank you. Sorry for that confusion. As I shared my slides, all the different screens in front of me changed, so I couldn't find the unmute button.
I'm not sure if I'm the only one, but I can only see a black screen right now.
Okay, it looks to me like it's showing the screen. Is it not showing? I can try just showing one more time, otherwise.
I can see the presentation.
It looks fine for me. I can see the cover slide.
You can see? Okay.
Yeah.
Okay.
Okay, I'll go with that then, Sonia, if that's okay. Hopefully it'll appear over time and it's just a delay. Okay, so I'm Helen Slinger and I'm Executive Director at an organisation called Accounting for Sustainability, or A4S for short. We work across the financial sector with the purpose of transforming finance for a sustainable future. So a lot of our work, not all of it by any stretch, but a lot of our work is with corporates, so with CFOs and their finance teams. And it's from that perspective that I'm largely looking now. So a lot of those finance teams are made up of accountants, as you might expect. And in my role, I also work a lot with accounting bodies, so CPA Canada being one of those examples. So this is the perspective that I'm coming from. So very specifically, that data needs for corporates and the accounting community. So that's not moved on, has it? Let me click again. There we go. So this slide will need no introduction to this audience, I'm sure. And the point that I want to make here in terms of where does well-being fit has actually been looked upon by Vincent already. He's talked to some of this, so I won't labour this point, but there are just a couple of things that I want to draw out. So if I ask that question, then where does well-being fit? So you can take a look at the SDGs and you could say, well, Helen, that's easy. That sits over in SDG 3, good health and well-being, and you'll be absolutely right. But if we're looking through the lens of the corporate, which of course is what I've been asked to do today, we could also say it's about well-being in the workplace over here on SDG 8, so decent work and economic growth. We could also be mindful that our employees are more than likely impacted by the current cost of living crisis and recognise that.
Can I just interrupt for a second? I'm really sorry. People in the chat are saying that they're seeing only the front page of your slideshow, and I'm not seeing it, so it's difficult for me to comment.
Okay, well, I'm clicking through it and it's showing on mine as clicks through. So let me unshare and I will come back and share it. If I share again, and we'll see if it works a second time. Okay, so just bear with me while I unshare and try and share again. You could see the front page. It's odd that it's not coming through because it worked when we tried it at the start, didn't it? So let's just see.
Vincent, I'm not sure if you are online right now, but can you just prepare in case we're not able to present the deck slides?
And now I'm just getting the black screen that you're getting. Yeah. Bear with me 1 second. It worked when I switched on to mute before and came back. So let me just try that.
Yay, I can see it.
You can see it now?
Yeah,
is that good?
I
can we get a general thumbs up or wave? Okay, we're good. Okay, so
you are on slide number 2. Yeah.
Yeah.
Perfect.
So
sorry about that.
And it looks
Thanks.
like it's the SDGs. Hopefully everyone can see that. Okay, great.
Yeah.
So as I was saying, we could also be mindful that our employees are more than likely impacted by the current cost of living crisis. So that interconnectivity of well-being with SDG 1, 2, 7 and 10. So reflecting, of course, poverty, hunger, affordable energy or not very affordable energy, as the case may be, and inequalities, and kind of see how that plays out. And reflecting back on the corporate, it's not only just about well-being in the workplace. The biggest impact of the corporate on employees' well-being, of course, is much more than what we've loosely termed well-being in the workplace here. It's about keeping them from unemployment and ensuring that they receive fair pay. But the point I really want to make, which is sort of backed up by what Vincent was saying earlier, is that it's been mindful that in all of this, there is so much more where that well-being connects with. So it's really closely interconnected with everything that we need to do to create a greener, a fairer and just society. And I've highlighted a few of those here. And it's this interconnectedness, this system view that's really important. The different levers that we pull within that system, either intentionally or otherwise, that can and do impact on well-being. And regardless of whether you're viewing well-being through that corporate lens, through a national or a societal lens, it's really important to think that through when we're looking at measuring it. Can I check that my slide has changed? Do you have a new slide now?
Yep.
Yeah. Great. Okay, good. So looking more specifically then at data needs of the accounting community in corporates. So there's two key reasons why data on well-being and on sustainability more widely is needed. The first and potentially the most important, and Richard Barker is no longer here to argue with me, the first and potentially most important is to inform how they make decisions. So I have on the left-hand side of the screen some examples of publications and projects that we've produced, and also some from our colleagues over at the Capitals Coalition. It's a little small on the screen, but you might be able to see just down here on the left-hand side where it says maturity map, the heading that says use of social and human capital information to deliver better outcomes. Now, that's what this is all about, really. It's about better outcomes, being better outcomes in financial terms, better financial outcomes, and better social and human capital outcomes. And recognising that social and human capital is exactly that. It's a capital. So if we invest in it, we can expect a return from it. And that term capital is something that accountants really understand. I'll say that again. If we invest in it, we expect a return from it. So really understanding that interplay between better social and human benefits and better financial outcomes. The maturity map that we have on the screen, what that does is that looks very specifically at actions that companies can take in this space, in their organisation and in their value chain to drive some of those better outcomes. Also on here, there's some interesting work being done on integrated capitals assessment. So we've got this principles of integrated capitals assessment that's been developed by the Capitals Coalition. And indeed, I believe that they are looking at combining the principles that they have in their social and human capital protocol, which you'll also see on the screen, with those in their natural capital protocol and bringing them together in an integrated capitals protocol, specifically to reflect that interconnectedness with a real focus on system thinking to inform how corporates make decisions. There's also a couple of projects they're running on accounting for a living wage and valuing human capital in health and safety. So by assigning a value to human health and safety and protecting the workforce, it can really give greater visibility and weight in decision making. So that value, if it's put in financial terms in particular, sits alongside financial information in whatever decision tool is being used, and like I say, gives it greater visibility and weight. Over on the right hand side, the other important data need is for reporting. So as Richard set out earlier, to meet the needs of investors, but also other stakeholders, which in turn supports their decisions. So either their investment decisions or decisions on where they want to spend their hard-earned money as customers. Now, I don't propose to go into reporting too much, given that we've already had a lot of information on that just now. But really just to make the point, it's an area that is exploding on the desks of corporates at the moment, in particular the desks of accountants who haven't historically really had to think about sustainability data much before. But given the focus on that financial related information, so reporting financially related sustainability information, it's really coming back to the accountants to support with doing that. So I think it's a very complex space at the moment. There have been various amalgamations into the IFRS Foundation. So the SASB standards and integrated reporting have all become part of that same organisation. But the key concerns across the whole landscape are broadly very similar. Those key concerns are about the accuracy of the data, the robustness of controls around the data, and of course the extent to which that data has been assured. All of those have become particular concerns because users really want to be able to rely on that information, of course, especially the investors. And that probably also helps to make clear why this is sitting on the desk of accountants, because accountants are already familiar with data accuracy, robustness of controls, assurance, whether they are the assurance providers or the people that are being subject to assurance. They kind of understand how that works, and they have the skills, the knowledge, the experience to be able to relay that onto sustainability information rather than the financial information that they're more accustomed to. The other point that I want to make is that there's a real risk that all the resources that are needed to focus on sustainability reporting at the moment will arguably take important time, effort and money away from the sustainability action, if you like. So I went to an event recently at one of the big four where they said that currently 80% of their work was either on climate transition plans, which is great, or on sustainability reporting, with a roughly 50-50 split. And the question in my head was, if there's so much consulting effort going into the reporting, who is advising the companies on the action? So I think the slicker we get the data process, the better quality information we get, the greater consistency and access that we have of corporates to good quality data to inform their decisions and to support their reporting, the better. Allows time for the actual action. Okay. So I wanted to spend the rest of my time just focusing quickly in on a little more of the detail on what it means to account for social and human capital in the companies that we work with. So back in 2007, we published the A4S Essential Guide to Social and Human Capital Accounting. And shortly after, we published some case studies from the corporates that are in our CFO leadership network. So, for example, some of the case studies, they honed in on accounting for the value of their human capital. And some of them, as this example here, on accounting for mental health, which of course is very closely related with well-being. The examples I have on screen reflect some of the work on mental health, and it's difficult to measure directly, but this company looked at some of the proxies that they could measure and feed into their decision making. So they looked at presenteeism and they looked at sick days, and converting these into dollars saved, if you like, from reduced sick days, and productivity benefits from improved presenteeism. So by measuring these, as they rolled out different mental health initiatives over time, they could get a real sense of the relative success of those initiatives and the benefit to employees, but obviously also the payback for the company. So I guess making that point again, human capital is something that you invest in and get a return from. So finding a way to help companies to measure some of these returns on their investment. So finally, going to the sort of next level of detail, just to give you a little bit more insight. This is an extract from an exercise that we've developed for the A4S Academy, which is a learning and implementation program that we run for senior finance professionals. It's essentially a simplified illustrative example of what it could look like if we included natural, social and human capital alongside financial capital, or what we've called here produced capital, on the face of the profit and loss account and balance sheet. So it's a multi-capital primary statement. So the tool asks the participants on the academy to work through an activity reflecting things like greenhouse gas emissions, employee training, health and safety incidents, protection and restoration of nature, the impact of aggressive tax schemes, etc. And what it does is it recognises the movement in the capitals through the profit and loss account and balance sheet. So Rich is now gone. I don't know if there are any other accountants on the call, but if there are, the specific journal entries are shown on the bottom right that show the capitalisation of human capital, i.e. recognising that human capital is an asset to the business. And it also shows a charge to the profit and loss account reflecting the depreciation of that asset over time if the employee doesn't invest in them with training, etc. So you'll hear many companies say, perhaps even some of your employers, that the people are their greatest asset. And indeed they often are. But that asset obviously isn't reflected in their financial statements. So what this is doing is taking that step and saying, well, what if we did recognise it? What would it look like if we started to consider social, human, natural capital and put that in our profit and loss and balance sheet? It also reflects the societal benefit of employment. So it gives the human capital asset on the balance sheet, but it also says there's a societal benefit as income to society. So given the rise in personal well-being from being gainfully employed, from being able to afford a home, feed your family, pay your taxes, and therefore contribute to society's infrastructure, to education, to healthcare, etc. All of that, of course, has a societal value. Now, again, if there are any accountants, I've just pulled that out and made it big on the profit and loss account to emphasise the point, give it visibility, whereas arguably this is a cumulative benefit as employees are taken on over time. So much of it probably belongs in retained profits rather than in the current year profit and loss account. But that's a detailed point. Hopefully the main point comes across. There's then an adjustment that I've got there in those journal entries in the bottom right for health and safety incidents. Similarly, you could do the same thing for well-being initiatives, see in terms of whether they're going well and elevating the human capital value. Here, what the health and safety incidents do, as you might expect, is that they decrease the human capital value and they increase the human capital charge to the profit and loss account. So, just in conclusion, when we think about well-being, we really need to think about its place in the system and the interconnected nature of that system. The data needs of accountants and corporates are for both decision-making and for reporting purposes. But accounting is evolving and finding ways to account for this important information, even in the absence of formal accounting standards. But it's not perfect yet. And I think anything that can be done to improve the quality of the data that's coming through, what economic data they have to be able to draw on, to be able to add a value to things like well-being, all of that is gratefully received.
Thank you, Ellen. This is really interesting. I'm an accountant, by the way, and I know Samir is one as well, one of our next presenters. We're gonna have the fourth presentation, and then we're gonna go through a discussion for both sessions, if you don't mind. Okay. So please write up your question for Ellen. We're gonna move through them in about 15 minutes. So I've seen that Jean-Emmanuel Deneuve is now online. If you can open your camera, please. So Jean-Emmanuel is a professor of economics and director at the Wellbeing Research Center in the Oxford University. And he's going to present us with measuring workplace well-being at scale. Hi,
Sonia. Sounds like you can hear me, which is great. I'm going to load load the slides that I've prepared, and you should be seeing those pretty much now. I'll make them big. Perfect. Wonderful. It's been wonderful to hear the presenters so far, and just the alignment. And I'll try and fill in a few of the holes and some of the issues that have been raised. I think I'll be able to put some metrics next to those and perhaps operationalize some of the possibilities here. So I'm really excited to introduce some of our work. We're currently guiding the world's largest study on measuring workplace well-being. and there's some important developments that you should know about. And I think all of this ultimately is about helping fill in the S in ESG, which is what workplace well-being in particular can do. We heard Richard Barker, my colleague at the Saïd Business School, speak earlier, and he mentioned things in the S pillar, such as child labour in the supply chain, health and safety. And those are very much on the risk side of things, but it would be a shame if we are not slightly more aspirational within S and also move on the opportunity side and improve the employee well-being. I think somebody's microphone is not on mute, so please, if you can do so, or if the organizers can mute that person, that'd be fantastic. Thank you. All right, without further ado, I'm gonna speak and structure my remarks over the next 50 minutes or 10-15 minutes across 3 questions that are most relevant to you. How do we measure workplace well-being? How do we do so at a scale not seen before? Second is, well, do these crowdsourced measures, is there any signal within that noise? In other words, is there external validity? And actually, Richard Barker sort of alluded to this work, and our presenter colleague from the OECD as well. We've done a lot of research on the links between how people feel at work and their performance at the individual behavioral level, but also now I'm pleased to say at the very much at the organizational level. And I'm going to share with you a brand new research that links well-being at workplaces to their financial stock market performance across all of the major corporates. And then finally, an important update, which is that S&P Global, with whom we've been working, have integrated everything you're about to see into their corporate sustainability assessment. And that's now evolving towards incorporating employee well-being as part of the S and the ESG ratings. All right, without further ado, how do we measure workplace well-being? There's already a lot of talk about this. So our view is that if you want a broad definition, well-being at work is essentially how we feel at work and about our work. And this gets perhaps best captured by items such as I feel happy at work most of the time, or the absence of negative stressors, which can be captured by I feel stressed at work most of the time. Those are measures that are about feeling at work, experience-based or affective in our world. If you want to care more about the evaluative items that are more thinking at how we feel about our work rather than at work, then we are looking more at a sense of purpose of work, and a classic measure and very much a workhorse item in labor economics, which is job satisfaction, is the one that's actually most used in the academic literature. That's a nice evaluative item. The aficionados amongst you, statisticians, and especially if you're involved with the Office for National Statistics in the United Kingdom, you'll recognize that what we've done here is transpose the ONS for general well-being items into the workplace. So the Office for National Statistics has been capturing well-being in the UK since 2012, if I'm not mistaken, and they ask about happiness, worry, worthwhileness, and life satisfaction. And so what we've done here is transpose that consensus in that world from general into essentially workplace well-being context. I spent a lot of time these days trying to make clear to people, and I'll do it again here on the call as well, that it's very important to conceptually distinguish between the outcome measures, like the ones I've just introduced to you, and distinguish those from their drivers. So items such as happiness and job satisfaction measure how we feel, which arguably is the output here, is the outcome measure and the KPI, if you will. Those need to be distinguished from why we feel the way we do. And a good example here is the OECD Better Lives framework, which was introduced before, which has 11 dimensions, one of which is subjective well-being, how we feel. And our sense is that a good way of evolving that framework would be to split off subjective well-being and essentially put it on top of the 10 more objective drivers, inputs into how we feel. And that then allows for a number of operational advantages. And we can get into that in the Q&A. So this is how we approach workplace well-being, and obviously it's the why we feel the way we do that, and it becomes helpful to try and improve workplace well-being. But you need that measure, that KPI, and that's what we propose is essentially the equivalent of the ONS4. How do we do so at a scale never seen before? Well, you need an extraordinary partner. And we found that in Indeed.com, which is the sister company to Glassdoor, that some of you will be familiar with as well. And they both belong to Recruit Holdings of Japan. And I think it's frankly Glassdoor and Indeed who are our best bets at getting comparable, I insist, comparable workplace well-being data across all major corporations, which is at stake here. Glassdoor has been at it for a longer time and do this by way of a rating. So think of the Glassdoor ratings as an ENPS, an Employee Net Promoter Score. And with Indeed, which is the study I've been guiding since 2019, we are essentially literally measuring items, the ones that I've suggested before. So workplace happiness, job satisfaction, stress, sense of purpose, and then about 10 drivers, the ones that you see appear on the screen, for example. We have a size and a scale not seen before. So in the space of 2.5 years, we have more than 15 million workers have told us how they felt and why they felt the way they do at their companies. And that is just coming in as we speak by the tens of thousands. So this is the world's largest study of workplace well-being. At the moment, most of our data sits in the United States, Canada, and the United Kingdom, which allows us to really compare most industries, companies, and even within companies, as you're about to see, across those markets. But it's actually being rolled out and active behind the scenes already in about 20 major markets, including places like Japan, India, Italy, Germany, you name it. So that's sort of the background. What we're finding is incredibly valuable is that there's huge variation, even within industries, in terms of workplace well-being, so how people feel at work. So there's definitely a lot of differences to be captured and introduced in the accounting standards that you're looking for. So for example, if we look at the 4 outcome measures, and they tend to operate in the same way, needless to say, if you look at the industry, which is probably the most similar or the most unique in terms of doing the exact same thing, which is flipping burgers, the hamburger industry. And you look at, for example, a McDonald's or an In-N-Out burger, which is a burger joint that the people on the West Coast in the United States or having traveled there will be very familiar with. And so you find that workers doing pretty much the exact same job feel very different at these places. If you look at the retail industry, whether it's a Walmart or a Costco or a Whole Foods or a Trader Joe's, you find big differences within very standardized industries in terms of how they make people feel at work. And so a big chunk of their social impact can get tracked and measured this way, and we find big differences within industries. Now, the data is so rich that we can even zoom within companies. I'm not sure how relevant this is to you, but I just want to show off the wealth of data we've got. So for example, in the big players around the world, we have so much data. So for example, for a Walmart or McDonald's, we have nearing 100,000 people having responded to us how they feel at work. And so things that we can do is slice and dice these data by who they are, what type of work they do, what titles they have, and so on and so forth, but even geographically. And the reason why I show these data, which are mapped by US states, is to show you sort of a good news story, which comes through these data very powerfully, is that while we find a lot of variation in workplace well-being, even in tough industries, in tough regions, or even in companies that aren't particularly well known to be the best places to work for, you will find units or geographies where people do feel good at work. And so I think this is very important because it shows that all the efforts being done by the people here on this call to try and standardize and set accounting rules around workplace well-being can push companies and industries in the right direction, and let nobody tell you that it's not possible, because even in the most difficult regions, industries, and companies, it is possible to find examples of units or plants where where people feel good and positive about their lives and their working lives. All right, so this gives you a bit of a sense of the descriptiveness and the richness of the data. I now want to show you, I'm skipping a lot of material, especially on the drivers, but what I wanted to show, because it's highly relevant and it was introduced both by our colleague from the OECD and Richard Barker, is that we've now put these data to use to show and link whether these link to financial performance. So are these data a leading indicator, potentially, financial performance, which is very important, obviously, for the ISSB and other rating agencies or accounting standards. So do they measure for, do they measure up for CFOs and accounting companies? And so what I'm about to show you, and what you're seeing now on the screen, is a brand new effort, which we published it only last month. It got a lot of attention. The Financial Times did a whole spread on it, very flattering, in fact. And so what you're seeing here is Our crowdsourced data for all of the major listed companies in the US. Why listed? Well, because they have systematically analyzed accounting data that is produced every quarter. And so we're able to dig into their financial reports and in a systematic way and tie that to the, again, systematically crowdsourced data through the Indeed platform. And what you're seeing here is that the average workplace well-being score coming back for a company, say Walmart, McDonald's, or anyone else, and on the New York Stock Exchange or the NASDAQ, that is very strongly correlated with financial performance, whether it's firm value, return on assets, or gross profitability. Now, obviously, this is as correlational as it gets, but we are digging into these data to try and see whether it's a leading indicator, whether it's predictive of financial performance. And the next slide, the one I'm showing you now, for example, like digs into this a little bit. As I said, we started the study in the crowdsourcing effort in late 2019, which is pre-COVID in the United States. And what you're seeing here is essentially workplace well-being being returned to us, the reviews pre-March 2020, and the financial performance on the vertical axis is post-COVID. And so this is still correlational. We're not talking causality yet, but it sort of hints at the fact that there's this does very much run in both directions and not just I mean that there is something flowing from how people feel to performance. And we also, as was highlighted, we've done a lot of research at the individual behavioral level to show with causal evidence that how people feel at work causally shapes their performance at work. And obviously companies that are a good place to work are more attractive employers and retain talent longer, which are also pathways to help explain why they end up doing better financially overall. Now, one exciting bit of information that got a lot of attention is also seeing whether these workplace well-being data are a leading indicator for stock market performance. So and I'll show you here on the screen. So the question I'm asking here is essentially, would our workplace well-being data be predictive of stock market performance? And in other words, a good indicator for companies, investors to use, and does all make it all the more relevant for accounting standards. What you're seeing here is just from January 2021 till about now, the NASDAQ and S&P 500 and Dow Jones. So these are our benchmarks. And what I'm going to show you on the next slide, imposing itself onto these benchmarks, is what a well-being portfolio would have done in those years. So we have data, as I said, from sort of late 2019 onwards. And so the first full year of data that we have to be able to rank, order, and build a portfolio is 2020. And so we use the 2020 data to inform a portfolio that we play and put in motion on January 1st, 2021. So, and then we do the same thing again on January 1st, 2022, where we rejig the portfolio in function of the best places to work for, as crowdsourced data tells us during 2021. This is the result of our portfolio, and it's highly suggestive of something important going on here, which is, just to remind you, what you're seeing here is the 2020 data predicting 2021 stock market performance, or should I say outperformance, and then in January 1st, 2022, we rejig the portfolio in function of the 2021 data, and it's been more resilient in the bear market. And then if you look at the start of 2023, so far the stock markets have been very volatile, but the well-being data based off of 2022, that portfolio, the well-being portfolio based off 2022 data, is outperforming quite well the current volatile markets. So what we're seeing here is something that my colleague at London Business School, Alex Edmonds, has shown before, but not quite at this scale or representativeness, which is that financial markets seem to not fully value the intangibles, as he coined it, the intangible of workplace well-being, how people feel at work. And if we were to get better data at this, or investors would have access to it, they might incorporate this more into their financial modeling. Now, I have to say there's only 3 players that have gotten access to the data. So it's us at Oxford who have access to these data. But one of the other 2 is BlackRock. And so BlackRock is taking a real interest in these data to inform their own investment strategies. The third group that has gained access to these data, and then I'll finish with that, is S&P Global. And the reason why is is that we've brokered a partnership between Indeed.com or Recruit Holdings, the holding on top of it, and S&P Global, because S&P Global, as you all know, do ESG ratings and sustainability ratings to influence financial markets and make sure that investors put their money where the work is being done sustainably. I'm so pleased to say that the corporate sustainability assessment that S&P Global does now since 1999 and covers well over 10,000 companies. From this year onwards, and in fact, to be more precise, from April onwards, when the CSA was sent out to all of these big corporates around the world, they've now evolved the S element, and they've included a trend of employee well-being, which is a methodological change this year, and it speaks to the hotness of this topic and the importance for businesses more generally. And I'm so pleased that S&P Global have taken a leadership role on this, and that we've been able to work with them on shaping up the CSA from now on. And so just so you know, what it in fact does is that across all the 62 industries that are covered by the Corporate Sustainability Assessment Framework, all corporates are now asked to essentially respond to the question, are you measuring employee well-being in your company? And if so, please share with us some of these data and evidence for it. And then they specifically ask about job satisfaction, happiness, stress, purpose levels, and also engagement. So you'll recognize the effort that we've done through Indeed, and our model of designing and measuring and capturing employee well-being has been adopted by S&P Global. And I've already had some feedback coming back from some major corporates that I've been in touch with at the corporate C-suite level, saying like, oh wow, yes, we've noticed that we're now being asked to return workplace well-being data. So my hope is that this will also help nudge all of these major corporates to start measuring well-being properly internally, share that with S&P Global, and then in turn also match that with the crowdsourced data. So I'm going to leave it at that and stop share screen if I can and hand it back over to all of you.
Perfect. Thank you so much, Jean-Emmanuel, for your participation in that session. So I'd like to gather the question for Ellen and Jean-Emmanuel in one question period. So I see one hand already up. Sorry, I can't see a name. So Wafa.
Yes, thank you very much, Sonia. Thank you, Sonia, and thank you, Jean-Emmanuel. Just a question on the methodology for data collection on Indeed. If it's useful to look at the UK Labour Survey, they have questions on satisfaction of employee. And I don't know if they can share with you the microdata, like maybe you can match like if they work in these specific companies, because sometimes like only privileged people who have like LinkedIn and apply through a platform can answer like those type of surveys, but the majority of people who work in less fortunate companies. If you want to have a larger view, it's good to benchmark and look at the UK survey on labour. And you can ask, I think, Richard to give you some privilege to have access to this data. And second thing, on the S&P survey, I just put in the chat that Elon Musk was furious about this S&P rating because they rated the oil companies and I don't know what better, or tobacco companies better than his Tesla cars. So that's it. Thank you.
Yeah, maybe two quick reactions. Thank you, Wafa, for both these questions and comments. The first thing on Elon Musk, S&P Global are very right to not have given Tesla a high ESG rating. While he does well on E with Tesla, he does very poorly on the S. And it's about time that it gets recognized in the way it does. He thought he can get away with just doing good for the planet, but he has to do good for people too. And so we, for example, in our own crowdsourced data, we've got thousands of Tesla employees who've responded to this, and he's well below average in terms of workplace well-being at Tesla. And so there's very, very much a truth to what S&P Global have come to, and the crowdsourced data back them up on this. On your really good point about the UK labour statistics, I couldn't agree more with you. It'll be fantastic to see the sort of the additional work on the external validity of the crowdsourced data. And you'll be very pleased to know we've gotten funding from the Nuffield Foundation in the UK to do precisely that. So we've started a project that will take a year to help dig into the external validity of these crowdsourced data. And I think these are going to be really important because all of you do wonderful work in your statistical agencies, and corporates themselves do internal work in terms of measuring. And then some big players like Gallup and others and Forrester have a number of clients that they measure, but they don't keep those data to themselves for their internal benchmarking processes. So my honest sense is that the only way that we're going to get comparable data across all corporates is going to be through big data approaches, in this case crowdsourced data, and hence all the more the importance of validity checking those kind of crowdsourced data. Thank you.
Thank you. Is there any other question for Ellen or Jean-Emmanuel? Samir.
Thank you. This has been a great session. I'm nervous because I'm the last one to kind of talk, but these ratings are really good. But I'm wondering if when you are collecting the data and running the analysis, whether you have seen some instance of social washing, with in these data, in the reporting.
Samir, whom is your question addressed to Helen or me?
To you, Jean-Emmanuel.
Okay. Yeah, so I very much align with your intuitions here. So when S&P Global does a CSA, they request this and send these surveys, which is a massive sort of assessment, but through a survey, essentially to the C-suite. And it's typically the chief human resource officer and the CFO who have to respond to these questions. There is a real risk of gaming this. I couldn't agree more with you, Samir, where they essentially what I call well-being washing. And they will say, oh, we're doing fantastic things for our people and our people are happy because we do X, Y, Z. The beauty, and I should have mentioned this before, is that this will, and I get goosebumps as I'm able to say it, this is no longer going to be the case because the crowdsourced data that we have, we're sharing it with S&P Global. And so S&P Global will be able to cross-validate what the companies return to them with the actual crowdsourced data. And that will provide them a richer picture of the truth.
Perfect, really interesting. Next hand up, I have Aldo Fenia.
Hello again. A question for Helen. You record human capital in the firm's assets. Now, actually, wouldn't it be more appropriate to say that this capital belongs to the people who work for the company and that the company owns a right given by a contract? So is human capital just short for that? Maybe as accountants, we should recognize that the capital belongs to households in this case. And then if I may, I have another remark. May I?
Yeah, go ahead.
Short one. So I was wondering, what does it mean for a company to invest in human or natural capital? And you underlined it is to get a return. You expressly underlined it.
Yeah.
Now, I am an environmental accountant, and there's the kind of capital I deal with. I don't like to call it capital, actually, but let's call it that way, is non-produced capital. Now, what does it mean to invest in something that is not produced and cannot be produced? It means appropriating some that already exists. And so this investment really means appropriating the rent that can be gotten from the services of this capital. So how does this relate in a wider sense with well-being of society at large? Thank you.
Okay, no problem. So I think your first point is absolutely right. Strictly speaking, that that value, that human capital asset, belongs to the people, and there's a very, I think, a very clear argument as to whether or not a company can claim that as their own, which is one of the reasons why it doesn't appear at the moment on balance sheets. But what it's seeking to do, that exercise, it's seeking to actually look across that population of people, add it all up, aggregate it all up, and say, actually, while they are employed by us, this has a value to us as an organisation. When they're no longer employed, obviously the capital relating to any particular individual goes off and travels with that person because it's rightfully theirs rather than be owned by the company. So your point is valid, and I think really what we're trying to do here is it's the concept, it's the illustrative idea. And essentially, I've applied an accounting policy by saying I'm going to collect that all up and show it on my balance sheet. Your second point about investing in nature. One of the examples that we work through when we do that exercise is we look at the restoration of an area of land that used to have a warehouse on it. So it's a brownfield site, but actually it's been brought back to a more natural habitat, so it's got greater biodiversity. Now that has intrinsic value from a nature perspective. Depending on its location, it also has societal value. So if there's access for the public, for example, they can use it from recreational purposes. It obviously also has a benefit from a climate perspective. We also talk about the example of actually where it can reduce flood risk for a company if it's by a river and the warehouse was previously flooded, and now the other warehouses have got better protection from that natural capital, because it's a natural flood zone and it's much less likely therefore to flood the rest of their site. So there's all sorts of different things that you can sort of weave into this, take from this, but yes, I think that it has a societal benefit and it has a natural capital benefit as well. We just bunched them all together on that slide and that example and called it all societal benefit, but it's much wider than that. But again, just a simplicity adjustment.
Thank you, Helen, and thank you, Jean-Emmanuel, for your contribution into today's presentation. So, Richard, I'm leaving the space to you for the next session. Thank you.
Thank you. So Sonia will be presenting in the next session. So I'm Richard Hayes from the ONS, and I'm going to be taking over chairing this final session on sustainability reporting and the challenges to expect and the perspectives of national statistics offices. And so we've got two speakers in the next session, Samir Tabelski from Brock University and Sonia Rezan, who has been our chair today. Looking at the urgent need for the adoption of international ESG standards and standard auditing mechanisms. Alongside this, thinking about the role that national statistics offices can play and how some experimental tools can be developed to think about this space. I'm going to move us straight on and straight forward to Samir. If you are happy to share your slides. Excellent, I can see your slides. They're not in full screen mode yet for me. There they are now. Over to you.
Thank you so much. Thank you for having me on this great panel. I really enjoy so far the presentation and the discussion. So the focus on my presentation is that it is time to adjust the country GDP for ESG. And no action is not an option. As you can see, there is a never-ending news on sustainability. Of course, there is the ESG enthusiastic, and these are the carbon credit, confuses the corporate world. Nature risk is the next challenge that demand a global solution. Canada efforts to facilitate emission reduction in agriculture fail in comparison to US, and so, but by the same time, there is this skeptic around the anti-ESG industry is taking investors to ride for many reasons, and the lack of harmonized standards, and that we're going to go over in the next slides. So as we all agree, for our value creation system to be sustainable, there is an interplay between the environmental and the society and the economy. So basically, if we were serious and consequential about creating growth and maintaining that growth, we need to, the financial capital is very important. And the manufactured capital is very important. But we need to kind of give an equal importance to the intellectual capital, to the social, cultural, relationship capital, human capital, and the natural capital. I'm going to skip this because by now we understand what is it E and S and G. The problem is that there is kind of alphabet soup and acronyms, and this list can go on and on and on. And it's time to simplify the acronym we're using, maybe to kind of make it easy for the average citizen to understand and be part of this global effort to take seriously ESG. As you can see from the statistics, all stakeholders hold business and government accountable. 58% buy or advocate for brand based on their belief and values. 60% choose the place to work based on their belief and value. 64% invest based on their belief and value. And 88% of institutional investors subject ESG to the same scrutiny as operational and financial consideration. Now, the sad news is that there is a lot of reporting standards. There is the Carbon Disclosure Project, the SASB standard, GRI, TCFD, and the list goes on. Not only that, many corporations, they use 1 or 2 or 3 or 4 reporting standards to convey their ESG performance. In theory, they're supposed to do so, but sometimes they may be also engaging in kind of pink washing, social washing, well-being washing, like, you know. Now, the problem with this is that these reporting, they are barely audited, and if they are audited by, it's a voluntary audit. Now, in the accounting front, only 31 companies get audited by an accounting firm. Most of the third-party insurance provider of ESG reporting is done by people like expert that with no accounting background. Now, a coherent and comprehensive system of corporate disclosure is needed to ensure that market can understand risks and opportunity related to social and environmental issues. And for that to happen, a globally accepted system for corporate disclosure can provide an important new insight into the vital interconnection between business and the world in which it operates. So it's a question of legitimacy, you know. These organizations and these government, they use the taxpayer money or the investor money, and they have to care about their its well-being. So around the world, investors collectively allocate tens of trillions of dollars, aiming that money's highest and best use for the society overall well-being. However, in the absence of consistent, reliable sustainability information, these investors or stakeholders, they're effectively aiming with 1A closed, right? Now, there has been some effort to kind of harmonize the sustainability disclosure landscape. The International Financial Reporting Standard Foundation is evaluating, creating, and they create the ISSB, which focus on investor use and how sustainability issues impact enterprise value. The initial focus is on climate, and it's going to expand to broader sustainability issue. And this initiative has a strong support from IOSCO. Now, there is also some joint effort among the voluntary framework and standard setter. In August 2020, a group of 5 paper established a vision for the field and the roles of the key player. The moment also is to move the TCFD disclosure from a voluntary to mandatory in many market. There has been also some effort at the European Commission, and the SEC, the US SEC, is requesting for input on climate disclosure. These efforts did not so far imply a one single set, widely adopted sustainability disclosure standards. Because of this, we have seen a lot of headline around greenwashing and social washing. And it's time to bring greenwashing under control. Former BlackRock executive blows the whistle on the greenwashing. And during the corona washing, they said corona washing for big bad business is the new greenwashing. And 2 recently, social washing could be the next greenwashing, according to Fitch Ratings. Now, the Biden administration US faces increasing calls to stop companies for undertaking greenwashing. So maybe standard setting is not the only way to go to curb green or any form of washing. We need a kind of interplay between standard setting, but strong enforcement. What is it, greenwashing? Greenwashing can be generally described as the practice of only paying a lip service to environmental, social, and governance factors. A study by Deloitte found that 80% of ESG disclosure are immaterial, and the International Consumer Protection Enforcement find that 40% of companies engage in greenwashing. These are kind of example of greenwashing. So we did a paper on whether investors see through greenwashing, and we used a sample of 5,148 firms, and we do find that engaging in greenwashing is really costly. A 1 standard deviation increase in greenwashing leads to firm equity premium to increase on average by 20 basis points. And we show that investors see through greenwashing and deceptive disclosure is costly. Now this brings me to my main message today. I think it is time to adjust to factor ESG into the growth calculus. Economics has not factored ESG risk changes into its growth calculus. To move the needle on climate action, mainstream economics need to get into steps with the ESG issues. So valuation centered on GDP does not adjust for society, well-being, ESG, and biodiversity damage. You know, in the East Asia miracle, implicitly celebrated fast GDP growth was done at the expense of ecological destruction. Rapid growth in China and India, as in advanced economy earlier, has worsened the environment, and South Asia has the highest rate of increase in emission, despite being the most climate vulnerable. Now, adjusting a country GDP for ESG involves incorporating sustainability and responsible businesses practices into the measurement and evaluation of the national economic performance. So while GDP is the traditional economic indicator that primarily focus on the economic output, incorporating ESG factors provides more comprehensive view of the country long-term economics and sustainability. Now, how we're going to go about this? These are the considerations that I think should be taken care to adjust GDP for ESG risk. At the environmental front, we need to adjust for carbon front and natural resources. And at the social factor front, we need to factor income inequality and labor practices. Now, at the governance front, I think corruption and lack of transparency, poor governance, make GDP not sustainable. And we have seen many countries, they are in debt distress because their GDP does not adjust in ESG factor. We saw a lot of Moody's, Fitch rating, and Standard & Poor's country rating when they say the perspective are negative because the ESG risk is very high. So the data is there. So all what we need is to just factor that in GDP. Now, growth analysis rightly emphasizes productivity in addition to physical and human capital accumulation, as well as worker participation, but ignores environmental sustainability. I strongly believe that the United Nations, the World Bank, and IMF Fund, which they do produce report on climate change, must integrate ESG impact into their growth projection. I can tell you that these global institutions, they have the carrot and sticks through their various funded program. They can make ESG as one of the conditions on running the program in particular country. In fact, the World Bank has a new climate change action plan that, among other things, aim to align operation of International Finance Corporation to the Paris goal by 2020. I think it is time to complement GDP with a measure of quality growth that is net of ESG damages. These are the key takeaways. I think, number one, we should work together. All the standards set up across the globe, they need to work together for a globally accepted high quality sustainability reporting standards. GDP adjusted for ESG is not an option. Action is urgent. It is important to know that adjusting GDP for ESG risk is a complex task, and we agree with that, and require the development of a robust methodology, data collection, frameworks, and an international consensus on ESG metrics. And I think this forum is a good starting point. Academics, the accounting profession, and I'm the president of the Canadian Academic Accounting Association, and we can contribute to this debate. The accounting profession, statistician, for now we are operating in a silo. And I think time comes now to break this silo so we can make the GDP and we can find a consequential way to adjust GDP for the ESG risk. There is originally I'm from Tunisia, a beautiful country by the Mediterranean. And there is this African code that say, alone we go fast. Like if we operate in a silo, each discipline, we're going to go fast. But together we can go far. Thank you very much.
Thank you very, very much. I'm going to move us straight on to Sonia to give her presentation, and then we'll take questions and answers and points raised at the end. So, Sonia, over to you.
Thank you, Richard.
I can see your slides, and they're perfect. In full screen. You're all good to go.
Okay, perfect. So I'm Sonia Rezen from Statistics Canada, and I'm here to present the NSO role regarding ESG data. The main objective of this presentation will be a demo from a tool that has been developed within Statistics Canada in the past 2 years. But before I start on the demo, I wanted to share the context, the Canadian context of where we started this initiative, but as well, I'd like you to initiate the thinking about what is the role for an NSO. I can present what Statistics Canada has done, but I did reach out to several NSOs in the past couple of months. Most of them are thinking about developing a program or a strategy to address these data gaps, but have not released anything just yet. So at the end of this presentation, I'm going to ask you a couple of questions. So I'd like to go a different route and ask the audience questions instead of receiving some. So concerning the Canadian context, so as previous speakers have already alluded to, there's no regulation in place as we speak. But that doesn't mean that there's no pressure for enterprise to publish voluntary disclosure on sustainability indicators. Most of the Canadian enterprise do include ESG factors in their financial statements already, but on a voluntary base. This voluntary disclosure comes with some challenges because there's no standard way to measure or to report on these. It does affect the public trust, which brings oftentimes the subject of greenwashing. In Canada and in most of the countries, all businesses are using IFRS standard in their financial statements, but there's no equivalent yet for non-financial reporting, which brings a couple of questions to mind. So how to measure ESG in a standardized way, how to audit ESG as well to make sure it is comparable within an industry, and also when can we expect a legislation to be able to standardize all of these practices. When we started this initiative, we started with exploring what was the lay of the land for ESG frameworks. So we basically reviewed all the frameworks that were already available at that time, which was mainly the ISSB and the GRI. We focused on the core indicators that were common to both frameworks. And also we reviewed what was produced by businesses in their financial statement as part of ESG indicators to make sure those were also aligned with the frameworks that were available to us. And we did extensive consultation with other government entities, with businesses, industry grouping, academics. So we did a large consultation, and one of the lessons learned from that experience is that there's as much data need in terms of ESG as people that you will consult. So the data needs are almost infinite, but in order to avoid scope creep, we had to target the core indicators and started with the kind of baby step approach. So started with a small number of indicators, small number of industry groupings. So we our first release was in March 2022, and initially we focused on, oops, I'm not sure why it changed, sorry. So initially we focused on natural resources industry as it was the more urgent need within Canada. Natural resource industry are a main contributor in the economy in Canada. So we had 4 industry grouping initially, now we're at 10, and we published initially 9 indicators and now we're at 12. So it's still an experimental dashboard. And we leverage existing data or indicators that we only had to tweak a little to be able to include them in the experimental dashboard. The objective of this dashboard is to have a benchmarking tool for enterprise and support them in the transition from traditional financial performance reporting to sustainability reporting. And since we are an objective firm, we do have, well, a role to play, but also we're able to produce objective data which will support this transition. This comes with a challenge as well. So one of the lessons learned during the engagement was that not all stakeholders are welcoming transparent data in that sphere, as right now it is it is not mandatory, so they can actually present in a manner that is that will put them in a good position, let's say, and having a transparent and objective firm not aligning with the ESG indicators that are produced can come with a couple of challenges. So here's the experimental dashboard that I'm talking about. I'm going to stop sharing the presentation and actually show you the live version of it. Richard, can you see my screen?
I can.
Perfect. So this is the front page, and from there you can pick and choose which option you'd like to investigate first. So let's take environment. So this is the tool that we've been working on for the past year and a half. In here, you see on the left side a brief definition of the indicator we're looking at. You can also pick and choose the industry grouping you'd like to investigate. So let's say mining, and the intensity variable, and also the time frame you'd like to see. And then it will adjust according to your research here. So we currently have 12 indicators, 10 industry groupings. At the bottom of the page, you can see the link to the data tables if you wish to consult, but also in there you'll have the methodology used to come with these metrics. Then on the social part, you have the same information as well. So brief description, time frame, all based on existing data within Statistics Canada. Some of the metrics are different depending on the indicator. So let's say for social, gender wage ratio, we have the hourly ratio or weekly. So there's a couple of indicators like this that we have different metrics to actually present the information. Just a second, going back to my slides. Can you see the slide?
I can, yes.
Okay, perfect. So possible next steps. Oops, I can hear echo here.
Can attendees please
Okay.
mute their microphones if they're not presenting? Thank you.
Thank you. So while we did consultation, there's a lot of needs, as I said previously, that were raised with us. One of the things we're trying to do right now is to secure funding to be able to expand on the work that has been done already. And if we are successful in that path, we're going to try to invest as well in ESG micro data file. That was one of the pressing needs that was expressed by users. So benchmarking tools that are more interactive as well. So a tool where the enterprise or businesses can include their own data and compare themselves with their industry grouping. And finally, we did start also engagement with Indigenous people, as in Canada, this is a sphere where the focus is on and has been for decades. So as part of this new project, for sure, we're going to investigate what are the options for Indigenous businesses as well. In here, what you see is a mock-up of a benchmarking tool that we've been working on for the past couple of months. This is all synthetic data and it's not released just yet. So it's under development still. But once the enterprise do enter their data on the right side, they'll be able to locate themselves within the distribution. So the black line is the enterprise data and where they're located. So this is one of the requests we have received from most of the stakeholders, and it's under development. So as I said initially, I'd like to have a meaningful discussion with you all guys and understand better. First, is that kind of tool the best approach or not? Like, we're open to the comments. but as well, I'd like to see us collaborate more and have a more, not a standard, but an approach that will fit most of the NSOs and not just within Statistic Canada, to be able to align and collaborate better. As I feel right now, we're all struggling with addressing these multiple data gaps. There's tons of initiatives underway with Data Gaps 3 and the revision of the SNA. So how can we leverage existing data to be able to feed into those framework, but as well we can feel the fatigue of framework and indicators. So how can we better organize so that it's easier for us to align and support those data needs? Richard, over to you.
Excellent. Thank you so much. So we have now time available for general questions, but also responses to Sonia's 2 questions there. So we'll open to the floor. Please raise your hand in normal fashion and I'll call you in the order that you appear. Vincent, come on in.
Yeah, thanks, Richard, and thanks, Sonia, for this great presentation. And I've been following Statistics Canada's work on this for a while, and I think it is relatively unique, at least from what we know in OECD countries. I don't think there are many countries that are doing similar things, so you're really pioneers here, and I think that's very exciting. So the way that I understand your work is essentially primarily to provide a tool that is relevant for businesses and investors in the ESG space, and I think that is a really helpful function. I think there's another type of function that NSOs can play thanks to the broader ESG space, and that is perhaps more directed to policymakers, and that is by using ESG data to provide more comprehensive information to policymakers on sectoral contributions to well-being and sustainability. Statistics Denmark a year or 2 ago did this really great study on sectoral contributions to the SDGs, where they unpacked the relative performance on sustainability and social aspects of different sectors. And I think, you know, from a policymaker perspective, it is so critical that we understand what different sectors are adding to our societies, right? And I think we are getting there, and we are getting there more on certain aspects of sustainability, on environmental sustainability, and on some aspects of social sustainability. But I think on social, we're really scratching the surface, and I think we can do a lot more to better understand what different sectors are bringing to our societies in terms of well-being. The type of research that Jan is doing, I think, also contributes to this. But I think NSO should really see these reporting standards, these initiatives, as a big opportunity to tap into a really potentially rich source of data on sectoral performance. And for that reason, I also think that NSO should really participate in these discussions around the development of these standards. You know, the ISSB is doing a lot of work on this. Other bodies are doing as well. I mentioned this potential task force on social and inequality related financial disclosures. And I really encourage NSOs to take part in these discussions because the interoperability, you know, there's a lot of momentum around this. And if we miss, you know, if you miss this opportunity, if we miss this opportunity, then we are stuck with metrics that are not aligned for a long time, right? And there's so many benefits to data interoperability. So I think this is a time where, you know, as Samir said, we need to do things together. We really need to break those silos, and the voice of NSOs in these broader ESG discussions, I think, is really welcome.
Excellent. And any other comments or questions anyone wants to come in with at this point? I mean, I was just going to follow very quickly on Vincent's, and then we'll give you a chance to answer. I mean, one of the things that strikes me that the importance here is thinking about these frameworks is many of these effects that we're looking at in this space. The worry is that we need to make sure we're also not double counting, and we're not seeing, as Vincent says, this sectoral approach that government are not claiming the same benefits as businesses are then claiming in their ESG returns. So there's a set of interesting questions there about how we align and think about frameworks in that sense. I will let Aldo pitch his question, and then we'll take those three all in one go. Aldo.
Thank you. I keep on raising my hand because I see nobody else does. Otherwise, I'd be glad to shut up. But I think what Mr. Samir Trabelsi is suggesting cannot go without a clear reply. And I think in your perspective, the meaning and use of GDP is greatly misunderstood. I mean, there's a huge literature about why it not just it isn't a well-being indicator, but it cannot be amended to be one. It is a measure of economic transactions. You can relate it comes from value added, which is a certain amount of money that firms have in there. It is related to consumption, investment, and excess exports on the one side, to the distributed income in real money. It reflects real money, and real money, whether it comes from health equipment saving lives or cluster bombs, doesn't make any difference. It is money you can use for whatever you want once you have it in your hands, and that's what we measure with GDP, and it is related to certain uses it has, and that even if a different summary indicator or composite indicator, whatever you want, of well-being comes up, that would be forgotten because those uses have their logic, which relates to what the GDP actually counts. Think, for instance, of the money European countries pay to the European Union based on gross national income, which is very much related to GDP. It's something plus and minus. Still, it is related to the ability of the country to pay with that real money. Think, for absurd, if we manage to protect the environment, make everybody happy with no market transactions at all, just a limit example, you would have zero ability to pay, but then you could not use your corrected GDP to pay that amount. So it's really, I think, out of history, thinking that GDP can be amended. Italy, in its sustainable and equitable well-being project and data set published now for more than 10 years, 12 different domains of well-being and sustainability and so forth, a dashboard if you want, has chosen a radically multidimensional perspective on well-being. And if we think about it, it is the SDG perspective, the being keeping separate things that need to be distinct, and the economy needs to be, or at least the monetary economy and its measure need to be confined where they belong. Thank you.
Thank you. So I'm going to pass back to Samir and Sonia to respond to those three, and I think I did see another hand that came up, and if we get time, we will come back to that.
Thank you for the question. I just want to do a follow up on what Vincent said, and I think we have to, as We have to break the silo, and in breaking the silo, we know we need to go because having metrics is not enough. I think because it's going to be like a check marks, right? So it's going to be a kind of compliance exercise. I think we need to really go, especially in the area of E and S and G. I mean, compliance is not going to make us better off. We need to go and focus on substance. How can we get businesses and government to genuinely invest in environment and social and governance? These standards are first. We need enforcement, and enforcement can be at the national level, can be at the global level. When it comes to ESG, we need a global effort. We need a joint effort. Otherwise, because I mean, some countries, they don't even, like most of African countries, they don't produce this environmental damage. They suffer from the environmental damage. So if we kind of go above the compliance and work together to kind of find a meaningful way to develop metrics, but we focus on substance, go way above the compliance. That will make us win this kind of heterogeneity and various interpretation of even the word ESG. In many countries they have different meaning. Now back to the adjusting the GDP. Excuse my accounting background, but in accounting we teach going concern, which is like when the business is compromised and going to go bankrupt. I think honestly, countries that have their GDP, but if they don't adjust for the damage they're causing for the environment and for the social, and they don't account for poor governance, I think that GDP is overstated. I mean, as a stakeholder, I want to know what's the GDP adjusted for ESGs for Canada as a citizen, so I can plan. There is an immigration flow now. We can't even go and said, okay, I'm going to go to this country because their GDP adjusted for ESG is their value creation channel is sustainable.
Sonia.
I'm not going to comment on GDP, but I'll go back to Vincent's comment, and I think you are completely right. And I think NSOs need to take that opportunity and take leadership in that space right now. It's taking time to be able to produce all of these data. Once the standards are published, if we don't take the opportunity now, we're going to be too late in the game to provide support to businesses during the transition. So to me, timing is everything, and hopefully I can convince some of my partners in other countries to jump in and come in and provide guidance as well, because what we've done is a really small dashboard. It took a lot of time, so I'd like to understand better what is in a global scene to be able to align myself.
I might abuse Chair's privilege to just touch on the GDP question as well, because I think it comes back to so much of what we're talking about in these sessions. Essentially, for me, any series of price or volume data is a form of well-being measure. It's just normally not a very, the price of chocolate bars, if the price of chocolate goes down, I can afford more chocolate. This is a good thing. The problem is it's not a very complete picture because it omits so much key information. I think this is the challenge with GDP. GDP is a measure of well-being. It's just not a very good one. It's a very incomplete one. But there are instances where if you're taking purely economic decisions, you need a purely economic number to guide you. And I think what we in our previous sprints have been discussing about the need for complements for GDP is to recognize, and I think this is where a lot of the debate is boiling down to, that there are instances where we are taking as society decisions and using GDP, a purely economic number, where actually we need additional information to help inform those decisions, and finding ways of incorporating ESG data, in this instance as under discussion today, into a metric to help better inform some of those decisions as a complement to GDP, because GDP tells you how much money it gives you a budget. It tells you how much money you have to spend on these things. It doesn't necessarily tell you where you want to spend that money. And the ESG data that we're talking about here gives you additional views on where you should be making your investment with the marginal dollar. So I think it is an important discussion about how we bring these data together. Whether one vehicle or another is the right vehicle to do it in, I expect we will always see some need for a traditional GDP metric, but we enhance data which can use the data being presented as part of the S&A revision or from businesses via ESG, I think is very important. We shouldn't fall into the trap of having a fight about, is this about GDP or is this not about GDP? It's got to be about a variety of metrics for a variety of purposes. Otherwise, we'll spend a lot of time arguing with each other about something that ultimately doesn't matter when there are far bigger questions at stake. Samir, you wanted to come back in.
Yeah, just one thing that also we need to kind of pay attention to is, this whole ESG reporting or indicator. The focus is always on the supplier front. So it's the businesses, it's the government, Stat Canada. And, John Emmanuel, he really presented today something very interesting. It will be great if we have a kind of mechanisms that we contrast with the users also. So we'll check what businesses are reporting in terms of E and S and G, but we can also go to those NGO and say what they think about what this supplier of the ESG data are saying. Is it credible data or not? So this way we can have because the problem is the data credibility, the reliability of the data we're getting, because we're doing benchmarking, but we need to do benchmarking on credible data. Otherwise, decisions are going to suffer.
Absolutely agree. Absolutely agree. I think the last hand has gone down, unless it wants to come back up. I'm going to suggest we've got 5 minutes to go, so I'm going to pass back to Sonia to give us her summarizing thoughts on today's session. Sonia, back to you.
Well, I think we've done a great job today at least feeding the S of ESG with well-being data. For sure, more to come. I think we probably need more in-depth discussion. I don't think that's the end of it. It's only a beginning, at least in my perspective. We're going to come back in September with the conclusion of this session and see where it brings us. If I'm not mistaken, Richard, the next sprint session, the fourth one, is on September 7th.
That's correct. We're taking a summer break, which will also give us time to reflect and think about all the good things which have been presented in the first 3 sprints. All the slides from all 3 sessions are available on the network's web page, which we'll put in the sidebar. Please do, if you missed any of the sessions, do come back and help yourself to those materials. Thank you all very, very much for an excellent session, which I think has opened many of our eyes. ESG, particularly for those in the national accounts community, isn't a topic we necessarily immediately turn to, but increasingly looking at the sessions today, I think we inevitably are going to need to, and think some quite deep thoughts about how we marry that data with more traditional data. Think about issues of double counting, think about issues of usage, and as Samir pointed out, issues of credibility and quality of data. And I think that absolutely has to be the foundation plate on which we'll build. Sonia, I don't know whether I just stole your ending. Sorry.
No, that's fine. Well, thank you all for your participation. I think we had a great session and we see you all back in September. Don't forget that the UNSC will send the invitation only last minute, so probably in the 24 hours prior to the session. So please mark your calendar to make sure you don't miss the next one. Thank you. Bonne journée.
Thank you.
Thank you.